This is Dr. T. Varalakshmi discussing you about the profitability ratios as a part of business economics and financial analysis. Profitability ratios. Once the organization has done the sales, out of that sales, if we less the cost incurred for that sales, remaining will be called as the profits. These profits are all again categorized into gross profit, that is if the direct expenses of that but direct cost of that sales is removed, then that will be called as gross profit. From the trading account we will get this gross profit levels, and if we less the indirect expenses on the products, we also will get the net profits. From profit and loss account we'll come to know that one and that too. So out of the total assets of the organization, that is the fixed assets as well as the current assets of the organization, or the total inventory of the organization, what are the sales percentage of the organization, and the return on assets, return on equity shareholders, profitability, how much of profitability they have given to the equity shareholders, and how much of profitability they have gained with this total assets, and the gross profit ratios, net profit ratios, everything is going to be taken care under the profitability ratios. So that's why it measures the management's overall efficiency in terms of the returns gained by the organization out of their sales. These profitability ratios include gross profit margin ratio, net profit margin ratio, operating profit margin ratio, return on total assets ratio, return on equity shareholders ratio. So all these profitability ratios, these formulas, advantages and disadvantages are summarized here. The net profit ratio is going to be calculating with the help of net income divided by the total sales formula, and it's a total conclusive ratio of the organization. Total profits is a profits position revealing of the organization, but it fails at comparing the different industries, but one industry level it can give the more best analysis. And the gross profit ratio will be calculating with the help of revenue minus cost of the goods sold divided by the revenue, where it checks the operational efficiency of the organization, how well they are going to be reducing the wastage and how well they are going to be selling more profits, more profitable goods, packaging, everything is going to be analyzing with the help of the gross profit margin. And it cannot rely upon the standalone ratio. Not only this gross profit ratio, only for the producer it is useful, but not for the others. That is its limitation. And the return on assets is going to be calculating with the formula of net income divided by average total assets to monitor the efficiency in utilization of the assets, but fails prey to manipulation. So that is any manipulations are not may be possible involved in this showing of these assets are also. And return on equity is going to be calculating with net income divided by average total sales, the average total equity gained by the organization. That is the reason for equity shareholders stay, and its investment possibilities are going to be evaluating here. And here it is chance of even that a segregation of the equity capital and debt capital may not be possible. Just to they can calculate what is the out of the total equity, what are the returns, or only can come to know that one. And return on capital employed is going to be calculating with the help of earnings before interest and tax to the total assets minus current liabilities. So that is out of the fixed assets, what is the beneficiary gained is going to be evaluating to judge the management performances efficiently, but it does not reflect the entire market value of the assets. Only one part of it is going to be taking into the consideration. That's a summary of the formulas related to the profitability ratios, formulas, advantages and disadvantages. So there are some other kind of that is second formulas are also we can use for this calculation of this profitability ratios. That is gross profit margin ratio, gross profit divided by net sales into 100, whereas the earning profit share, that is net income minus preference dividend divided by weightage average outstanding shares. ROCE, return on capital employed, can be calculated with net operating profit or earnings before interest and tax divided by capital employed into 100, and net profit margin, that is net income divided by net sales into 100, and return on equity, that is net income divided by average shareholders equity. Earnings before interest, tax and other allowances, amortization, can be calculated with the help of this revenue minus expenses, and return on assets, ROE, can be calculated with the help of net income divided by average total assets into 100. Dividend yield ratios, operating profit margins, all these are all can be easily calculated with the help of these profitability ratios. So the importance of these profitability ratios, if we observe, it gives the total financial performance of the manager in terms of the profits and losses. These ratios are calculated to analyze the earning capacity of the organization, and this gives the close relationship between the profits and efficiency of the organization, and it will use more useful for the setting of standards in this financial metrics, and we can compare the expenditures on that product easily, and these ratios will give the more analysis of high value relations to the competitors ratio can easily identify with the help of these profitability ratios. Here, especially if we have to discuss about this gross profit ratio, means it is also known as gross margin ratio, which gives the relationship between the total gross profits out of the net sales done by the organization. So the gross profits, if directly trading account, we can take into the consideration. If they won't get, we can use another formula to find out this gross profit, that is net sales plus closing stock minus opening stock minus cost of the goods sold, will gives the analysis of the gross profit. This ratio is going to be calculating to the lender's point of view, what is the business organization's honorability in payment of these EMIs, and to the management's point of view, how efficient they are all in saving the cost of the goods sold, and in the owner's point of view, it gives the profit levels at their operational levels. And generally, higher gross profit margin ratio gives a good sign for the business, and a bad sign of lower gross profit ratio is indicating for the organizations. Same as this gross profit ratio, up to the gross profit ratio, before that interest and taxations, what is the benefit gained by the organization, operational efficiencies were established. After the interest and taxations, what is the net profits left with the organization, how well it is going to be giving worthy to the investors is going to be calculating with the help of this net profit ratio, that is the impact of the indirect taxes impact on the productional elements are easily identifying with the help of this net profit ratio. And here the formula using this one is net sales divided by net profits divided by net sales, whereas the net profits will be calculated with the help of profits before interest and tax, and net sales will indicate the gross sales minus sales returns. And here it is going to be interpreting the specific benchmark levels and the total cost impact on the revenue generating by the organization, and it is useful for the comparison of the past periods and comparison of the one industry with another industry also. Next thing, third ratio, that is operating profit ratio, gives the relationship between the operating profits to the total sales. It measures the percentage of the total sales and the cost of goods sold by the organization, and how well they are operating, and what is the efficiency of their labor, machinery, goods, maintenances is going to be evaluating with the help of these operating profit ratios. Earning per share value. So that indicates that how the organization is finally giving benefits to the equity shareholders after paying the taxations as well as the dividends or interest to the dividends to the preference shareholders and interest to the debenture shareholders, and finally to the equity shareholders, what is the market price value. And this is the best method to analyze the market conditions, because every investor, before going to purchasing the shares of that business, will think about the earning per share value. That indicates the overall beneficiary created by the organization to the equity shareholders, and this is very important for the shareholders to get to evaluate their efficiency of the returns gained from the organization. The next thing is return on earnings, ROE, which is called as here the return on earnings by the equity holder, or the earnings out of their investments. Both the ways we can calculate. That is only in the form of the equity, what are the benefit gained by the organization, only out of the total investment of the organization, what is the benefit they have gained. So that's why here the formulas of this ROE will indicates net income divided by the equity shareholders, whereas the ROI indicates the EBIT, earnings before interest and tax, divided by the total investments. That indicates the company's utilization of the owner's equity is revealing with this return on equity. The company's beneficiary out of the total funds will be going to be calculating with this ROI, return on investments. That is the one. ROI, if the interpretation, if we see ROI is equals to ROE, the no interest involved in this one, the entire capital is gained by the equity members. If ROE is greater than ROI, we can say that interest component is very less. Interest component is very less. If ROE is less than ROI, the organization has more relied on debt. That interpretation can be done with this ROI and ROE. And next element, ROA, that is return on assets. So out of the total assets, that is fixed assets as well as the current assets, what is the profits gained is that assets are all really get benefited for the business activities, that is going to be calculating with the help of this one. If the less ratio of the ROA comes, means there is a more wastage of the assets, which means they have purchased the land, they are not at all using. They have purchased the machinery, they are not at all using. So how well they are using that assets is going to be easily calculating with the return on assets value. Return on capital employed means profitability of the organization on the net operating profits after taxes to the capital employed. That is, what is the previous investments are present added capital, and with this total capital, what is the net profits gained by the organization is going to be calculating with the help of ROCE, that is return on capital employed by the organization. So for this capital investment, the benefit gained by the organization is going to be calculating with the help of this return on capital employed. The next thing is earnings before interest, tax, depreciation and amortization. That is EBITDA is going to be calculating with a total organization earnings, and after depreciation and after the amortizations levels, and what is the accountancy beneficiary to the organization, and the overall entire organizational benefits with the previous elements is going to be calculating with the help of this EBITDA. And this is the most frequently gives the knowledge of entire gross profit, net profit. That is a summary of gross profit, net profit, return on equity, return on assets, and good taxability impacts on the business. Everything is going to be calculating with the help of these earnings before interest and tax margins. Then they have calculated this dividend yield ratio, that is dividend payable by the organizations, that too equity to the preference or only takes into the consideration, then that will be called as dividend payout ratio, that gives the knowledge of what is the equity capital and what is the dividend payable to the shareholders, that will only take into the consideration. So that's about the various profitability ratios, their formulas, their usage for the calculation or to evaluate the business efficiency of the organization. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.